Happy New Year, everyone. I'm Jamie French here to bring you a brief market update. And I know that some of you are maybe new to Advent Partners, so just want to say hello to you and tell you how excited we are to get to know you and serve you going forward. I'm hoping today to share a brief update. Last week, Colin Byrne from our team shared some timeless wisdom from Warren Buffett, and that's a tough act to follow, but I'm hopefully I will share some helpful information. I'm going to do that by focusing on three topics. One is some inflation data that came out and the Fed's reaction to that. Secondly, a brief recap of 2025. And then lastly, what's our outlook for 2026? So starting with inflation, obviously the Fed pays close attention to inflation, and we pay close attention to what the Fed is doing. Inflation data came out this week and will continue to come out this week, but it's coming in relatively close to expectations. So when we look back to the end of last year, the Fed cut rates in September, October, and December, and that helped support a strong stock and bond market. There's a lot of debate about what actions they're going to take in the next year, how many rate cuts there will be. I'm guessing it'll be quiet initially, and we'll be paying attention to see how that pans out. Speaking of the stock market, last year was a really strong year in the market, supported by strong earnings. A key learning from last year, diversification, was really important. Asset classes such as gold and international equities had really strong years. And the S&P 500 did really well, too. It was north of 17%. But in terms of relative comparison, it was middle of the pack compared to a lot of the other asset classes or funds that we have in a lot of our client portfolios. So just a reminder of the importance of diversifying beyond just the S&P 500. The bond market also had a strong year, supported by those interest rate cuts, really for the first time since 2022. And then even for conservative investors, even with the rate cuts, you could still get a decent interest rate on cash. So really good news across the board in 2025 for investors of every risk tolerance. So what does that mean for 2026? Well, first of all, valuations in the market are high. And so that creates some risk, but optimism remains based on the underlying fundamentals, as well as the continued development of artificial intelligence and all of the industries that support that. And I know as I say that, a number of people are drawing some parallels between the late 90s, where we had, great stock market returns and kind of this tech bubble, and then the bubble burst in the early 2000s were painful for investors. But there are some fundamental differences between then and now. The first is valuation. While valuations are high now, back in the late 90s, they were significantly higher. You had a lot of small tech startups, a lot of debt financing going on. And the fundamental difference now is a lot of the development in AI is being driven by large, established, profitable companies with strong balance sheets. So while valuations are high, they're not as high as they were in the late 90s. And then in addition, a lot of the capital investment that's happening is being financed by retained earnings and corporate cash as opposed to debt financing. So fundamentally, it looks different, but I can certainly understand people seeing the parallels in terms of market performance and the development of technology. So what's this all mean going forward? Well, certainly there's reason for optimism, but I would say cautious optimism. And earnings are going to be important, so we want to be paying attention to that. And the real lesson is the same as always. Whether we're in good markets or bad, it's important to monitor and adjust the portfolio. It's why we do what we do. It's the work we're doing behind the scenes to watch the markets and make adjustments. And if you want to have any conversations about that, please reach out to us. Thanks for listening today and have a great week.